Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Kansas City and Minneapolis wheat markets.
Kansas City wheat. It is no longer a surprise to me to yet again this week see prices hitting and sometimes utilizing the bright red trend line formed of the neckline of the small but influential October 2021 to January 2022 head and shoulders top, currently at 849. Now, as I have said repeatedly in my commentaries, this market has occasionally staged rallies up to the 50% Fibonacci line of the August 2020 May 2021 move at 900. But then these rallies have stalled and the market has instead turned and expanded the downside. As a result, the declines in April constructed a monthly key reversal down, and very nearly the same for the month of May, but instead choosing to make a lesser outside month pattern instead. These moves down and then back up apparently created a diamond pattern type for the action from April to April and May, and as we also entered into June. I repeat my comments on this pattern now for a third week. You see, I am really not happy about this pattern type at all, but for the moment it seems it might be useful, so I've outlined it in bright green on my daily chart. The reason why it is outlined is that 2 weeks ago the market broke up and out of this pattern type, thus indicating an initial primary target X for such a pattern move in a 902 area, just over the 50% Fibonacci line for the August 2020 to May 2021 move, and with a further harder to reach secondary target X1 up in the 946 level. Now, we had a lot of resistances in the way before we went up to 900, and that explains why prices started to stutter up here last week. One of these we already know about, and that's the red neckline. But we also have the 2014 high at 856, the 2013 high at 862, and especially the following three, which have been recently reloaded, which have really eroded the immediate bullish incentive of recent times. They are the flatlining long moving average, currently at 866, the 50% Fibonacci line of the September 2019 to May 2022 move at 881, and at the 900 area, specifically the August 2020 to May 2021 move. Now, these all work together in varying degrees to halt the rise, creating a horn top over last week and this, and sending the market back down. This move lower offsets the weekly key reversal up made 2 weeks ago, and directly threatens the recent lopsided diamond pattern, which is highlighted in bright green on my daily chart. As I said earlier, I really wasn't that happy with this pattern last week. I am on the very point of actually retiring it this week, or at least restructuring it completely. If prices should start to drop, then start sitting around the lower uptrend extension of the diamond, currently at 792. Then I will still keep the lopsided diamond pattern. However, a punching down through this extension, and especially the breached December 2020 to date uptrend, just below, currently at 776, will cause me to seriously look at retiring this pattern. So it'll be interesting times ahead, perhaps. Minneapolis wheat. Compared to Chicago wheat and Kansas City wheat, Minneapolis wheat here continues to be a somewhat easier read with respect to what is going on and what the opportunities might be. In late January this year, prices punched up and out of the upper bear channel line of the first bear channel, constructed between October 2022 and March this year. Then 16 weeks ago, we had the first piece of bearish pressure coming from how the medium moving average, currently 851, capped the market in mid-February with a subsequent move lower. There was then some hesitation, which eventually became a bear flag over the turn of February into March. It was at this time that the market constructed a new second bear channel, that after a period of time morphed into what we have seen in recent days, a descending, expanding wedge pattern, currently 723 to 871, originating from late December last year, but really becoming evident from February this year. This is highlighted in dark blue on my daily chart. The upper trend line, currently 871, had been previously reinforced, well, sort of reinforced, by the declining medium moving average, currently 851, which combined to help cap the market in very early April. They had mid-April and mid-May as well, capping the market there. The last 2 weeks saw another attempt higher through the short medium moving average, currently 831. The medium moving average, the August 2022 low, 862, the 2017 high, 868, and finally breaking up over and closing over the upper trend line, currently 871 of the descending expanding wedge pattern. However, rather than exploit this significant break higher, the market chose to form a horn top, with the second spike being a daily key reversal down. And we saw prices drop back within the descending expanding wedge pattern again and move all the way down until we started hesitating again around the slowly declining short medium moving average, and especially above the congestion between 820 to 800 formed by the actions over late May and early June. This pullback down may well have repaired the damage the break higher last week over the upper trend line may have incurred. Last week I started or raised one further item which I'd like to revisit, as after publishing my commentary I noticed another possible pattern here. So it's something I spoke about 3 weeks ago and I raised ever since, and I quote, "The only other feature is a potential, and just that, a potential double bottom formed since April. It is why early on that, as early as anything more than an idea, it's way early on that." End of quote. I added 2 weeks ago the following, and I quote, "It is still early, but I can set out some idea of when this potential pattern could become a real thing. And that would be what prices do should they get to the 890 level. That would be more like where to look out for signs of this truly being a possible double bottom pattern. I'd like to add one further point to this. Look closely also at the now flatlining medium moving average that is just above, currently at 897. I am sure this moving average will play a key part in any move up in the 890 area." End of quote. Well, this long moving average definitely played a part in the action around 890, capping the market, creating the horn top, and thus leading the market lower. I may retire this pattern idea next time. It will depend on the action, but before then, I'd like to point out something I saw last week, after I had published my commentary. Let's look at the whole action since late February as a possible reverse head and shoulders pattern. I have marked the likely spots for the two shoulders and the head, and though it's sloped and not a perfect pattern by any means, it still has merit. Perhaps more merit than the double bottom idea. The upper trend line of the descending expanding wedge pattern, currently at 871, can be used as a neckline. Now, one thing to remember, head and shoulders patterns are usually seen as reversing patterns, in this case bullish. However, they can also be seen as a continuation pattern, though you may have to keep a close eye on these times, on these ones actually. I'll keep a close eye on this one, whichever way it turns out.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.